to today's explainer. Let's just jump straight right into your high-speed pre-market wrap-up. Overnight, the markets were hit with some serious geopolitical shocks, and we are going to break down the exact catalysts and map out the actionable technical levels you absolutely need for today's trading session. Let's get to the data. So we are starting with a major risk-off tone today as the Middle East abruptly enters a really dangerous new phase. The US and Iran have actually traded fresh missile strikes. Washington just announced a renewed naval blockade on Iranian ports, while Iran is insisting it remains the guardian of the Strait of Hormuz. Geopolitics is completely back in the driver's seat here.
And look, the market is pricing this stress test very aggressively. The sudden collapse of that maritime MOU triggered a massive energy spike. We saw Brent crude surge right past $84 a barrel. That extends its weekly gains to over 10%.
Now, you can probably guess what happened next. This direct supply shock triggered an immediate domino effect right down Wall Street. Higher oil and mounting tensions sparked a really swift sell-off in semiconductors. Meanwhile, the bond market reacted violently. The US 10-year Treasury yield surged 11 basis points to hit 4.631%.
Section 1. India Macro Snapshot. Resilience versus reality.
Right now, we've got this fascinating tug-of-war going on between market resilience and macroeconomic reality. Indian equities actually weathered the global storm, with the Sensex and Nifty recovering intraday losses to finish flat. But, the macro data is flashing red warnings. India's June trade deficit widened to a 5-month high of $30.4 billion, and CPI accelerated to 4.38%. Make no mistake, the oil shock is definitely knocking on India's door.
Section 2. Major currencies, catalysts, and technicals.
Starting with the DXY, the US dollar bounced back sharply right alongside that oil spike, and it was really fueled by hawkish warnings from Fed Governor Christopher Waller. Because of this, traders are treating today's upcoming US CPI print less like a routine data release and honestly more like a high-stakes season finale to see if core inflation is remaining sticky.
So tactically, the DXY remains a solid buy on dips. Your immediate overhead resistance sits at 101.41, followed by 101.80. If we get a pullback, watch support at 101.89, but your crucial floor is really that 147 to 157 zone. Definitely map these out for tonight's CPI drop.
Over in Europe, the euro sold off sharply. Yes, it was driven by oil, but it was also heavily influenced by ECB President Christine Lagarde. She noted that while inflation was stabilizing, they remain, quote, acutely sensitive to import costs and energy channels that could alter our trajectory. She speaks again tonight, so expect some volatility there.
With the German 10-year yield creeping up 9 basis points on that rising oil, the euro has actually fallen below key support. So the tactical play shifts to sell on rise. Immediate overhead resistance is 11388, with a secondary ceiling at 11457. On the downside, keep an eye on that 11310 support.
For the pound, the catalyst is almost identical. The Bank of England's Hugh Pill confirmed that the Strait of Hormuz escalation is a direct supply shock, altering their inflation pathway. This pushed the UK 10-year yield to test that massive 5% psychological level. Keep an ear out for Governor Bailey, who is speaking later today.
Now, the pound fell sharply, but it actually found footing right at the 50-week moving average of 1.3343. This sets up a cautious buy on dips trade. Resistance sits at 1.3393, but hey, if that 50-week support breaks, your next floor down is 1.3326.
Looking over at Japan, the USDJPY pair is navigating some really intense domestic warnings right now. Bank of Japan Governor Kazuo Ueda addressed Parliament with a very clear message. The continuous weakening of the yen significantly amplifies import price pressures, and that's demanding future policy adjustments.
And adding some serious structural fuel to the fire for BOJ policy adjustments, Japan just recorded a 3.1% year-over-year nominal wage increase. That's massive. It's the longest continuous streak of wage expansion they've seen since 1992. Technically speaking, USDJPY is stuck in a highly tricky zone right now, balancing that oil spike against Japan's yield recovery. The absolute safest technical play here is a sell, but listen carefully. You do it strictly with a hard stop, exactly at the 162.71 resistance level.
Section 3. India Markets, Currency and Equities Technicals.
The primary catalyst for USDINR today is the rupee slipping to an intraday one-month low of 95.85. It's getting heavily weighed down by crude, that 5-month high trade deficit we talked about, and rising CPI. However, public sector bank dollar selling jumped in and really helped cap those losses, closing the session at 95.62.
Tactically, that resistance at 95.82 held up, which keeps the overall structure a buy on dips. Support is sitting at 95.43 and 95.21, but if 95.82 does break, you need to watch the key weekly pivot at 96.05. A move through there opens up 96.18 pretty rapidly.
Over on the Nifty 50, buying the intraday dip paid off beautifully, settling just above 24,200. This actually highlights a massive internal sector divergence. The recovery was heavily driven by the IT sector, which surged 3.5%, perfectly offsetting a heavy drag from both FMCG and metals.
For the Nifty, the broader structure remains a buy on dips. Overhead resistances to watch are 24,561 and 25,344. But the really crucial takeaway here is the support confluence at 23,900. If we see a break below that level, it opens up a really steep downside target of 23,576.
So, to wrap this all up, geopolitics is firmly back in the driver's seat today, and these headlines are moving markets much faster than pure economics. Risk management is absolutely paramount right now. Watch your technical levels closely. And I'll leave you with this one thought. With the Fed watching like a hawk, how are you positioning your book for tonight's high-stakes US CPI print?